Bismillahirrahmanirrahim. Today we are going to start chapter 3. Chapter name is Audit Reporting. Chapter objectives are: first, we will understand the meaning of audit reporting, that what is audit reporting, then meaning and purpose of audit report, why we conduct audit, what is the purpose. Then after that we will discuss different types of audit report. Then after that we will identify the contents of audit report, that which things will be included in an audit report. Discuss the reliability of audit report, that was what is the reliability of audit report. Then we will identify the stages of audit, that what are different stages in an audit. Know general principles governing audit, that in conducting audit, what are the main principles for conducting an audit. And then the last topic that we will discuss in this chapter, it will be the concept of audit evidence. Our first topic is audit reporting. What is audit reporting? An audit of a company's financial statement should result in a report wherein the accountant or auditor is free to share their opinion about the validity and reliability of a company's financial statement. Whenever an auditor is coming to check the financial record of a company, then at the end of that audit, he will give his opinion. He will give a report. Report about what? Report about the validity, that these financial statements are valid, and reliable. Reliability of a company's financial statements. So, auditor will give his opinion about the validity of financial statements and the reliability of a company's financial statement. We call it audit report. In this report, the auditor should provide an accurate picture of company and their financial statements. He will provide a complete, accurate picture of the company and their financial statements. The auditor should also state whether they are externally or internally connected to the company, and auditor will also say that if he is externally connected to the company or internally connected to the company, whether he is an external auditor or he is an internal auditor. Within the report, the auditor can share any reservations about the conditions of a company's finances or relevant additional information. Now, in the audit report, auditor can share any reservation if he had some questions in mind, if he has some points. He can ask these questions from the management about the conditions of the company finances or relevant additional information or any other relevant additional information. He can ask questions. Reservation could arise if the auditor disagrees with something found in the financial statement. Suppose he will ask question if the company is using one policy and he is not satisfied with that policy. If company is using one depreciation method and he is not satisfied with that method, so he will ask questions from the management of the company. Like here is an example: if the auditor disagrees with management about the valuation of an asset. Suppose in the valuation of an asset, company gives their point that we evaluate it by this method, But auditor is not satisfied because they believe that this has a more significant impact on the financial statement. Now the auditor disagrees with this valuation method. So he can ask questions because the management, they have their own belief. Auditor, he has his own belief. He has his own idea. So auditor, on the base of his idea, on the base of his opinion, he can ask questions from the management. Why you use this valuation method? Why you didn't use this method? So this is what reservations, that if he had some questions in mind, so he can ask these questions from the management. When financial statements are finalized, they usually must contain an evaluation. Whenever auditor is coming and he is checking the financial statements, then the end result will be an evaluation, means the auditor's report from a licensed accountant. And who is giving this report? A licensed accountant. We call it auditor or auditor. This evaluation or report provides an overview of the validity and reliability of company or organization's financial statement. We already discussed that he will check the validity, that these figures in the financial statements, these are valid and these are reliable. The goal of an auditor's report is to document reasonable assurance that company financial statements are free from error. What is the goal of the auditor's report? Is to document reasonable assurance. Reasonable assurance means he wants to make sure that these financial statements are free from errors and fraud. So the goal of auditor report is to make sure that these financial statements are free from error and fraud. There are rules concerning what an auditor's report should include and the order in which various items should be reported. Whenever an auditor is writing a report, in this report he will follow some standards. In these standards, it is defined which thing will be included and what will be the order in which various items should be reported. We will discuss it later on, that first thing, which thing will come first, then what will be the second thing, then what will be the next thing. So there is a rule, there are rules regarding the audit report, that which things will be included in audit report and what will be the order of these things. Auditor's report must adhere to accepted standard established by governing bodies. So in their audit report, they will follow the accepted standard established by governing bodies. This is known as audit reporting. What is an audit report? The auditor report is a disclaimer, in short, is a view, is an opinion which is issued by either an internal auditor or an independent external auditor. Internal auditor, he can give his opinion. External independent auditor, he can give his opinion as a result of internal or external audit. Internal audit. So internal auditor will give his opinion on the basis of internal audit conducted, and external auditor will give his opinion on the basis of external audit conducted, in order for the user to make decisions on the results of the audit. And these information are useful for the users and for decision makers. Users, You know about users of financial statements? Banks, financial institutions, government authorities, the employees, management, and decision makers, those people who are making decisions. And these users of financial statements, they are making decision on the base of the results of audit. We'll discuss this thing later on. An auditor's report is considered an essential tool when reporting financial information to users. Keep in mind, audit is one of the most important things considered by the users of financial statements, particularly in business, since many third-party users prefer or even require financial information to be certified by an independent external auditor. And they will trust all those financial statements which are audited. If the financial statements are not audited, nobody will trust it. Like suppose there is a bank, your company, this is suppose company, and company give an application to a bank, suppose this is a bank, for a loan. So now this bank is user of the financial statements of this company. Now if the financial statements of this company, these are audited, this bank will give more weight to the financial statements of this company. But if these financial statements are not audited by external auditor, I'm not talking about internal auditor, there is possibility that management will pressurize the internal auditor that give a favorable financial statement, make a favorable financial statement. But external auditor, there is no pressure of management on him. So bank will trust and bank will give more weight to the audited financial statements of an independent auditor. Similarly, government, similarly, other financial institutions, similarly, if someone want to purchase this company, or you can say investors. So these people will give more weight if these financial statements are audited and there is a report, audit report of this company. Many auditees rely on auditors' reports to certify their information in order to attract investors. And for attracting investors, the audited financial statements are very important. Obtain loans when the company wants to take loans, then in that case audited financial statements are important. And improve public appearance, and in the eyes of public, if you want to make your image good, so it is important that your financial statements are audited. Some have even stated that the financial information without an auditor's report is essentially worthless for investing purposes. So some of the external users, they said that if the financial statements are not audited, there is no auditor's report attached with the financial statements of that company, essentially, so that financial statement is worthless, means there is no weight, means there is no meaning of that financial statement, and that is for mostly investing purposes. Those people who want to invest in this company, so these investors, they will give weight only to the audited financial statement. And if financial statements are not audited, nobody will come to your company. No, you can't attract the investor. The company cannot attract the investors because their financial statement will be considered worthless. An audit report is basically the opinion of an independent auditor regarding the financial and accounting information maintained in an organization by its accountant. So in simple words, audit report is the opinion of an independent auditor regarding the financial and accounting information maintained by an accountant. Now the question is, what stands for auditor's opinion? The auditor in his report cannot claim that the financial statements do show a true and fair view. Keep in mind, whenever you are conducting an audit, I told you in the class that audit is based on sample base. We are not checking all the transactions. We are not checking each and everything. We are making a sample, and on the base of sample, we are making our opinion. So in his opinion, he cannot claim that the financial statements do show. Do show means that there is no mistake, there is no fraud. Show a true and fair view. He cannot 100% with 100% accuracy, he cannot say it. He cannot give his opinion that these financial statements are true and fair, gives a true and fair view, because it is on the base of sample. Those things which are coming in sample, so they are checking those things. And those things which are not coming in sample, they cannot say anything about that. I told you, this is the whole company. This is all the financial information of the company. There are thousands of transactions. So they cannot check all these transactions. They will take samples. Some items from this point, some items from here, some items from here. On the base of sample, if the mistakes or frauds come into this sample, so they will say on the base of that. If mistake and samples, they are not coming in this sample, then they cannot say that the financial statement do give true and fair view. So I'm telling you, suppose the fraud is here. Another auditor comes and he checks and he found that here is fraud. So one auditor, on the base of his samples, he cannot give 100% opinion that the financial statements are gives fully true and fair view. He cannot say this thing that yes, 100% the financial statements of this company gives true and fair view. If something is not coming in this sample, then they cannot say something about that. So here he's telling you that he cannot claim that the financial statements do show. This is the most important. This do is very important. Do show means these are 100% true, gives 100% true and fair view. He cannot claim this thing because he's using sample. He can only say that in his opinion, the financial statements show a true and fair view. He cannot say that the financial statements 100% gives true and fair view. He can only say that in his opinion, the financial statements show a true and fair view. The reader or user of financial statements will know from his knowledge of the auditor whether or not to rely on the auditor's opinion. If an auditor is reliable, he is well known, So on the base of that, we can say that we can trust his opinion. If auditor is well known, is experienced, so on the base of that, the reader or users of financial statement rely on auditor's opinion. If the auditor is known to be independent, honest, and competent, then his opinion will be relied. And there are different types of people in the society. Some people are honest, some people are dishonest, some people are competent, some people are incompetent. So if an auditor is independent, he is honest, he is competent, then his opinion will be relied. We can trust his opinion. Okay, I think for today it is enough. Inshallah, in the next class, then we will talk about types of audit reports.